Even though clearing houses are exposed to every trade on the exchange, they have more tools to manage credit risk. Clearing houses can issue margin calls to demand traders to deposit initial margin money when they open a position, and deposit variation margin or mark to market margin monies when existing positions experience daily losses. A margin is generally in is collateral that the holder of a financial instrument has to deposit to cover some or all of the credit risk of their counterparty. In this case, the central counterparty clearing houses, traders on both sides of a trade, has to deposit initial margin, and this amount is kept by the clearing house and not repeated to other traders. Clearing houses calculate day-to-day profit and loss amounts by marking to market all positions by setting their new cost to the previous day's settlement value and computing the difference between their current day settlement value and new cost. When traders accumulate losses on their positions such that the balance of their existing posted margin and their new debits from losses is below a threshold called a maintenance margin, usually a fraction of their initial margin. At the end of the day, they have to send variation margin to the exchange, who passes that money to traders making profit on the opposite side of that position. When traders accumulate profits on their positions that their margin balance is above the maintenance margin, they are entitled to withdraw the excess balance. The margin system ensures that on any given day, if all parties in a trade close their positions after variation margin payments after settlement, nobody would need to make any further payments as the losing side of the position would have already sent the whole amount they owe to the profiting side of the position. The clearing house do not keep any variation margin. When traders cannot pay the variation margin they owe or are otherwise in default, the clearing house closes their positions and tries to cover their remaining obligations to other traders using their posted initial margin and any reserves available to the clearing house. Several popular methods are used to compute initial margins. They include the CME-owned span agreed simulation method used by the CME and other 70 other exchanges, stands a Monte Carlo simulation-based methodology used by the Options Clearing Corporation, teams earlier used by the OCC and still being used by a few other exchanges. Thanks a lot.